Welcome back, everyone, for another deep dive. You ready to unpack this crazy week in the markets?
Oh, absolutely. Buckle up. This one's a wild ride.
It's enough to make your head spin trying to follow all the ups and downs.
Right. It can feel like a roller coaster sometimes.
So let's break it all down and figure out what really matters. Starting with the big picture.
All right, let's set the stage.
We saw the Dow Jones eke out a tiny little gain, just 0.4%. It ended at 44,882.13.
Modest gains there for sure.
The S&P 500 did a little bit better, up 0.5% to close at 6,071.179. But then there's the Nasdaq, and I'm sure a lot of our listeners felt this one. Took a dip down 1.6% to finish at 19,880.799. What's with the mixed bag here?
Well, one word, tariffs. President Trump dropped a bombshell this week.
Yeah, he did.
Announcing new tariffs on Mexico, Canada, and China.
I actually did choke on my coffee when I read that headline.
It was a triple whammy. Definitely sent shockwaves through the market.
But here's the thing. The market didn't completely tank. It kind of stabilized. Why is that?
Well, I think investors are trying to read between the lines here.
Right.
Are these tariffs actually going to happen, or is it all just part of some elaborate negotiation tactic?
Yeah. It wouldn't be the first time we've seen this kind of posturing, right?
Exactly. The market's been down this road before, and it tends to react more to the rhetoric than the reality.
So maybe investors are becoming a little bit immune to the drama. But tariffs aside, we also had a ton of earnings reports coming out this week.
Oh, yeah. It was a full-on earnings extravaganza. Some companies absolutely killed it, and others, well, let's just say they left us wanting more.
Let's start with the good news. IBM. They had a phenomenal week with their stocks surging a whopping 13% after their earnings report.
Yeah, they knocked it out of the park.
Now, I know IBM has been making a big push into artificial intelligence and cloud computing. Do you think that's what's driving their success?
Absolutely. Their performance really highlights how companies that are successfully pivoting to these high-growth areas are reaping the rewards. It's a lesson for all of us. Keeping an eye on these larger trends can give you a real edge in the market.
So it's not just about picking individual stocks. It's about understanding these bigger forces that are shaping the market.
Precisely. Now, on the flip side, we have companies like SoFi Technologies. Despite exceeding their Q4 expectations, their stock actually dropped.
Really? Why is that?
They issued lower guidance for the year ahead. That spooked some investors.
So even if a company's doing well now, if investors aren't confident about their future prospects, it can really hit their stock price.
Exactly. Perception is everything in the market.
So what happened with SoFi? Is their challenge unique, or is it a sign of something bigger?
That's a great question. SoFi operates in the fintech space, which is facing some headwinds right now. Increased competition, regulatory scrutiny. Their lower guidance might reflect those broader challenges.
So understanding a company's specific situation is key. But we also need to consider the overall industry and market dynamics.
Couldn't have said it better myself.
Now, speaking of market dynamics, let's talk about NVIDIA. Remember how we talk about investors being really sensitive to anything AI related?
Oh, yeah. That's a hot topic right now.
Well, NVIDIA is a major player in that space, and their stock had a dramatic plunge this week, dropping 13% in a single day.
Yeah, that was a wild ride.
When I saw that headline, I almost panicked. But then their stock ended the week down only 0.8%. How's that even possible?
It just goes to show how sensitive the market is to news and sentiment, especially when it comes to AI. NVIDIA is a bellwether for the industry, so any hint of trouble sends ripples throughout the tech sector. But when things seem less dire, the market rebounds quickly. It's a roller coaster.
No kidding. And speaking of roller coasters, the Nasdaq's overall decline this week is making me a bit nervous. What's the story there?
It seems to reflect broader concerns about the potential for increased competition from China, particularly in the AI arena.
That's interesting.
Investors are starting to wonder if U.S. tech companies can maintain their dominance in the face of this new challenge. It's a valid concern.
Yeah, that's a big question mark hanging over the tech sector. So we've got tariffs creating uncertainty, companies adapting to new technologies like AI, and this looming challenge from China.
It's a lot to digest.
It's enough to make anyone's head spin.
Absolutely. You know what's interesting, though? Despite all this uncertainty in the market, consumer discretionary and consumer staples sectors actually saw gains this week.
Oh, yeah. You know what? I was curious about that myself. You'd think with all the tariff talk and potential economic slowdown, people would be pulling back on their spending.
You would, right.
But it seems like we're not. What's going on there?
It's a bit of a head-scratcher. Maybe consumers are just feeling more resilient than we think. Or maybe it's a sign that inflation's still top of mind.
Yeah.
And people are trying to buy things now before prices climb even higher.
Okay, so it's like a spend now, worry later kind of mentality.
Right.
Interesting. You know something else I noticed in the report? Utilities and real estate.
Mm.
Both sectors had solid gains this week. What's the takeaway there?
You're picking up on some key signals. Utilities and real estate are often considered safe havens for investors. When the market gets volatile, investors tend to move their money into sectors that are seen as more stable and reliable.
So it's like riding out the storm in a cozy cabin.
Exactly. It's a classic flight to safety.
That makes sense.
Hmm.
But hold on. If investors are looking for safety, wouldn't bonds be a better bet than real estate?
You'd think so, right? And we did see a slight uptick in demand for treasuries following the tariff news.
Oh.
But the impact wasn't as pronounced as some analysts expected. The yield on the 10-year Treasury note actually rose slightly to 4.81%.
All right, but I got to be honest. I'm not entirely sure what that means for the average investor. Can you break it down for us?
Sure. Think of it this way. When you buy a Treasury note, you're essentially lending money to the government for a set period of time.
Okay.
The yield is basically the interest rate you earn on that loan.
Right.
So when the yield goes up, it suggests that investors are demanding a higher return for lending their money. Maybe because they perceive more risk in the market.
So a rising yield could be a sign that investors are a little bit nervous about the future.
That's one interpretation. But it also suggests that the market sees room for economic expansion. It's a delicate balance. Investors are weighing those potential risks of inflation and tariffs against the potential rewards of a growing economy.
It sounds like the market's holding its breath, waiting to see what happens next.
Exactly. It's a wait-and-see moment. Speaking of holding your breath, did you see what happened with Apple this week?
Oh, yeah. They released their earnings report, right?
They did.
I saw the headlines, but I have to admit, I haven't had a chance to really dive into the details. What should we know?
Well, they had a decent report overall. Growth in iPhone sales, revenues up, and there's always, but analysts weren't entirely convinced that Apple can maintain this momentum, especially with all those concerns about global economic growth looming.
So even a giant like Apple isn't immune to these market pressures.
Nobody is. It's a constant game of chess, trying to anticipate the next move, adapt to changing consumer behavior, and navigate that incredibly complex global landscape.
Speaking of navigating complexity, we talked about IBM's success with AI earlier. And then there's NVIDIA with their wild stock swings. I'm sensing a theme here. Is artificial intelligence the key to unlocking future growth?
It's definitely a major driving force. Remember, we discussed the Nasdaq's decline. Part of that's fueled by concerns about competition from China.
Right.
Specifically in the AI space. Yeah. Investors are really placing their bets on those companies that are leading the charge in this technological revolution.
So it's not just about understanding AI itself. It's about identifying the companies that are best positioned to really leverage it for growth.
Absolutely. It's about seeing the why behind the numbers, understanding what forces are really shaping the market, and recognizing which companies are riding that wave of innovation.
It makes you realize there's so much more to investing than just picking stocks.
It's a whole different way of looking at the world.
This has been incredibly insightful. I feel like I'm starting to see the market through a whole new lens. It's not just a random jumble of stocks and numbers. It's a reflection of us, our world, our innovations, our hopes, our fears.
I love that perspective. It's about connecting those dots between the market and the bigger picture.
Right. Before we get too philosophical, though, I'm curious about one more thing: alternative investments. You touched on those briefly earlier, and I think our listeners would love to hear more.
Absolutely. With so much uncertainty in those traditional stock and bond markets, investors are increasingly looking for other ways to diversify and potentially generate returns. We're seeing growing interest in things like real estate, private equity, commodities, and even those digital assets like cryptocurrencies.
It's like investors are expanding their horizons, looking for opportunities beyond the usual suspect.
Exactly. And this trend, it's only going to accelerate as the investment landscape continues to evolve.
Okay, so we've covered a lot of ground here. Stocks, bonds, economic indicators, geopolitical events, the rise of AI, even those alternative investments. It's a lot to take in, but I'm definitely feeling more confident about understanding what's really driving the market, not just reacting to the headlines. What do you think? Are we ready for the final stretch of our deep dive?
Let's do it.
Okay, so we've covered a ton of ground this week. Everything from tariffs and AI to consumer spending and alternative investments. Phew, it's been quite a ride. But I feel like I'm starting to get a better grasp on what's really driving the market. What do you think? Anything else we should touch on before we wrap things up?
I think there's one more crucial takeaway for our listeners. It's about connecting these market trends to the bigger picture, to the forces that are shaping our world.
Okay. I'm intrigued. How do we do that?
Well, think about some of the companies that did well this week. Companies like IBM, Tesla, even AT&T. What do they all have in common?
Well, they all seem to be embracing technology and innovation.
Right.
IBM's all in on AI and cloud computing. Tesla's revolutionizing the auto industry with electric vehicles and self-driving technology. And AT&T's investing heavily in their fiber network. Keep us all connected, of course.
Exactly. And that speaks to a larger trend. The companies that are not just keeping pace with technology, but actively driving it forward, they're the ones anticipating the future, pushing boundaries, creating solutions for tomorrow's challenges.
So investing in these companies is almost like investing in the future itself. It's not just about today's profits, but about betting on the companies that are shaping the world we're going to live in.
I love that way of thinking about it. And it's not just about technology either. Remember when we talked about consumer behavior earlier?
Yeah.
That resilience in spending, despite all the economic uncertainty, tells us something really important about the underlying dynamics of the economy.
It's a sign of hope, maybe.
It could be. It definitely shows a certain level of confidence. I think the key takeaway here is that it's not enough to just look at the numbers. We need to understand the story behind them, the human element, the trends that are shaping the way we live, work, and spend.
You're right. It's about connecting the dots.
Absolutely. And that brings us back to the core of what we do here at the Deep Dive. Our goal is to equip you with the knowledge and insights to navigate the market, not just react to it, to help you see those patterns, the connections, the forces that are at play, so you can make informed decisions that align with your goals.
I feel like I've gained a whole new perspective on the market. It's not just a random collection of stocks and numbers. It's a reflection of us.
It is. It's a reflection of our hopes and fears, our innovations and challenges.
This has been eye-opening, truly. I feel so much more empowered now to make sense of this crazy market.
That's what we like to hear. And as you continue on your investing journey, remember this. Don't just follow the headlines. Look for the underlying trends. The bigger picture. Ask yourself, are a company's challenges unique, or are they part of a broader trend? Paying attention to those patterns can help you understand the market story, not just the headlines.
That's a great point to end on. Thanks for joining us on this deep dive into the market. We covered it all this week, didn't we? Tariffs, tech giants, consumer confidence, alternative investments. What a whirlwind. I hope you're feeling as empowered as I am to navigate this ever-changing landscape.
Me too. And remember, the market's always going to throw us curveballs, both good and bad. The key is to stay informed, stay curious, and never stop learning.
Well said. Until next week, happy investing, everyone.